Here's what's coming up on the Peak Financial Freedom Show with Jim and Dan.
I want you to imagine, rather than somebody put you into a portfolio and you call them once a quarter, and when the market goes down, they tell you to stay the course. We're not going to tell you that. We are mechanically managing money with algorithms. It's all done with math and science with no emotional decision making.
We got their fees down to 1.19%, which means over the next 20 years, they can plan on potentially saving over $900,000 of fees, which means they either put that in their pocket as extra income, or they have it that they can pass on more money to beneficiaries versus losing them in fees.
When you explain it simply and you take your time as an advisor to dispel that skill set onto them, they start to really feel comfortable and know their money.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Welcome to this week's show.
We have 30 minutes of great information designed just for you.
Don't go anywhere. Make yourselves very comfortable because the show starts right now.
Hi, and welcome back to this week's Author's Corner. I'm here with Jim and Dan. They are best-selling authors, TV personalities, and TV talk show hosts. And guys, we have a great topic today: money and anxiety. We know money can bring anxiety if not planned for correctly. Jim, I'll begin with you. Let's talk about risk for a moment. If someone's worried about taking too much risk, how do you help them stop worrying about large losses in the market?
Often we have to change their entire mindset because they've been usually at a stage where they've been taught or indoctrinated by the industry that you need to take risk in order to succeed in retirement. But if you're getting close to retirement, you have to understand how to de-risk your portfolio, and that's what we do here. We're actually a risk mitigation firm because in order for us to generate income that's going to last for the rest of your life, we have to control the risk inside that portfolio. So we're actually using technology to determine the risk inside a portfolio. We can actually tell you within a 95% accuracy how much you're likely going to lose in the next stock market crash, not only in percentages, but more importantly, in dollars and cents, so you actually understand it. So if, for example, if you have a 60-40 portfolio right now, you probably have a 38.52% risk factor. Market goes down by 50, you're going to go down by 38.52%. And when you actually put that in dollars and cents, it's really mind-blowing to people, because if you have $1 million and losing 40%, you're down $400,000. It's significant. So we have to control that risk. We got to get that risk so it's less than 10% by using the strategies we use in our firm.
Yeah, and probably the big anxiety money piece, Dan, is am I going to run out of money and still have a whole lot of life left?
Well, what causes anxiety to most people, no matter what the reason is, it's uncertainty. So it's uncertainty of what's going to happen. Will my money last, or will it run out? Will I suffer big loss? All these things. And it's uncertainty that causes people to worry so much about their money. And we bring the uncertainty out of money by developing a written plan. And the written plan now allows us to show, okay, we can now put in writing that if you have a certain amount of money going into the green bucket, our green bucket is principal protection, guaranteed lifetime income. That's using fixed index annuities with income riders. Okay, everyone says, oh my gosh, the A word, it's a bad word. What if that annuity can provide you income at a fairly high level, guaranteed for as long as you live, regardless of what happens in the market, no matter how much the market crashes, no matter how long you live, and no matter how much you earn, and even if you run out of assets in your account, they have to continue to pay the income. We think that's a great way to be able to contractually guarantee you in writing that your income will never run out. That's the only way you can get rid of that fear.
Yeah, and Jim, let me ask you this, because there are a lot of fears out there, right? And I think to some degree, people might have a little bit of shame. They don't understand what they have. They don't understand what the next thing is. How do you mitigate that? How do you help people who might feel a little shame? I don't really understand my money, but I've accumulated a good amount.
Yeah. Well, they've been taught by the industry is diversify your assets, which people don't even really understand what that is. And when the market goes down, they call their advisor. What the advisor tell them to do? Stay in it, don't get out. Well, they've been taught that, but that's the wrong lesson, right? You have to be educated on money. And as you get older, people think less and less about their knowledge base. They don't think they know enough about their money. So what we do in our entire educational process is we make it simple for the clients now to understand their money. We divide it into 3 buckets, make it real simple. We have a safety bucket, which is cash in the bank and CDs, right? It's liquid, you can use it, it's not going to lose any money. We have a principal protected bucket that Dan just mentioned, where it has principal protection, income for the rest of your life. And then we have a growth bucket where money's in the market. We're using algorithms, a mechanical system to control the risk. We're running stop loss technology every night. When you explain it simply and you take your time as an advisor to dispel that skill set onto them, they start to really, really feel comfortable and know their money.
Yeah, and let me go one step further. I heard it described one time when someone comes in with their accounts to talk to an advisor. And first of all, you guys are extremely approachable. I've worked with you for years. The analogy was like when you go to the doctor and they say, okay, you have to put on this gown, and there's not a whole lot to it. It's the I'm now financially vulnerable, right? And they'd get that shame piece and bring it in there. And part of that is, I haven't really planned for the direction. I know something, Dan, needs to change here. How do we help someone feel good about that? And I don't necessarily mean a hospital gown.
Yeah, the whole thing comes down to listening to the client, finding out what the client wants. Do not put any of our own wants, needs, and beliefs in. Find out what the client really wants their money to do for them, because up to this point, only thing the client has done has invested their assets for growth. That's all they knew they were supposed to do. Grow it as much as you can. Take the risk. It's okay. It'll do well. Now you had to find out, what do you really want that money to do for you, for your spouse, and for your family, and then put a plan together that now gives you the highest chance out of work. They're going to say, I don't want to make big mistakes. I don't want to have big losses. Make sure in writing that the plan states that. I want a high level of income guaranteed for as long as I live. Make sure in writing the plan says that. I want to leave money to my kids. Make ssure the plan in writing says that. I don't want to take much risk, and I don't want to pay too many fees, and I don't want to pay too much in tax. Make sure the plan's in writing and it says that.
You know, it's funny. I think for a lot of people watching, you were speaking a foreign language. Make sure it's written out. And then at the end of your plan, both of you guys sign it.
That's right.
So it's not just a plan here, walk out. No, we're putting our signature on it. Dan, Jim, thanks so much. If you want more information about anything we spoke about here today, hey, pick up that phone, come meet us, 916-452-7325, or go to our website. And don't go anywhere. We'll be right back.
Hi, I'm Jim Files, CEO of Peak Financial, your local resource for retirement and investment planning, acting as fiduciaries for advisory clients. We're offering you a free, worry-free retirement roadmap, including a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all free, no pressure, no obligation, guaranteed. There's no risk and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
On this week's segment of We Fix Your Money, you're going to meet Rob and Terry. They're in their late 60s, just sold a successful business, and don't know what to do next. They're worried about making financial mistakes like taking too much risk or running out of money in retirement. Now over to Dan and Jim to tell you how they helped Rob and Terry.
Thanks, Mark. We're so excited to be here for this week's hypothetical case study. We're going to talk about Rob and Terry. And they're retired now. They're 67. They have 3 kids. And they're retired because they just have successfully sold their business that they ran for over 35 years. They don't have a pension, but they get $50,000 of joint Social Security. They've done well of $2.6 million of assets, which includes the business they just sold. They just inherited a house from, I believe, her mom, and that's worth $1 million that they sold, so that also is there. They have $200,000 owed on their home. That one of the things we're going to recommend most likely is they get that thing paid off. They consider themselves moderate investors, but they really don't want to lose much at all. And they want an organized plan. Now, knowing that they no longer have the business that was generating the income that provided them their lifestyle, they have to make their assets produce the income that now will create their lifestyle. And they're really unsure if they've succeeded because they have no idea. No one's ever been able to pinpoint, are they going to be okay for the rest of their lives? And as we talked about, they have no pensions. They need income that's going to last forever. They've had 2 planners in the San Francisco Bay Area because that's where they used to live, but they moved up here, and they want local help. They want someone they can sit across the desk from, meet, and come into the office anytime they want without having to drive 2, 3, 4 hours in traffic. And they want to stop worrying about multiple things. One is their home loan. They got a $2,000 monthly payment. Their brokers, both of them say, keep paying the payments. We don't really agree with that. They want to do a $100,000 remodel. They're not sure if they can afford to do it at this point in their life. They're worried about risk and suffering big losses, and they're deathly afraid of their money running out because they know, at this age, they can't go back and get a new job. They've sold their business. What are they going to do? So it puts them in a position where they worry a lot about their money. So we have to do a lot of analysis to find out where they're at.
Yeah, as you notice here, there's a lot of moving parts here, but this is typical with all of our clients that we deal with, because once we get down to identify what they want their money to do for them, a lot of these things come up and we have to manage through these in the planning process. For in this example, they had $200,000 in the bank. They had no money allocated to pay off their house. They had no money allocated to remodel, which they wanted to do. They had $3.4 million in their growth bucket. They had no money at all in the protected and lifetime income bucket. And they had, again, $3.6 million of total assets. We increased their bank money from $200,000 up to $300,000. We thought they needed that additional liquidity. We actually set money aside for them to pay off that house, get rid of the payment, lower their stress, pay off their home. That was ideal in this situation. We allocated $100,000 up front so they had money to remodel their house. And we put $1.5 million in the growth bucket. We put $1.5 million in the protected principal and lifetime income bucket. We had to do that to lower their risk and increase their income based on what the client's objectives were. Same $3.6 million. The key here is we lowered the risk substantially. They had a 35.7% risk factor, which means if the market dropped by 50%, they were going to lose approximately 36% of their asset base, which meant they were going to lose about $1.285 million, and they'd have to need a 55% rate of return to make up that 35% loss, which was substantial and really shocking to this set of clients. We reduced that risk factor down to 5.1%, so rather than losing 35% of the money, they were projected to lose closer to 5%, and we only were down $183,000, not down $1.285 million, which was a significant difference, and we needed a 5.4% rate of return to recover that 5.1% loss, which was a lot less and a lot more doable than where they were when they met us, Dan.
So from going from current to the with plan allocation, it gave them what they needed to now have a successful retirement. Well, let's look at what it really did for their income in an income assessment. Currently, they're using $50,000 of income from their assets, none of it guaranteed. We now are going to increase their income to $135,000 a year with $100,000 of the $135,000 guaranteed for as long as they both live. Think about that. $100,000 of income guaranteed for as long as they live, and we only needed $1.5 million of their assets to do that. It was a great way to create income that they felt comfortable with because they didn't have any pensions. Their current fees they were paying were 2.46% all in, advisor fees, management fees, fund fees, trading costs, etc. We got their fees down to 1.19%, which means over the next 20 years, they can plan on potentially saving over $900,000 of fees, which means they either put that in their pocket as extra income or they have it that they can pass on more money to beneficiaries versus losing them in fees. And when you look at this type of assessment, it allows us to then do their monthly income assessment, which is paramount.
Yeah, in this example, we were able to get them gross monthly income of $17,000 a month. Taxes, federal and state, were about $2,881. Net after-tax income was $14,234. This couple had a budget of $10,000 a month they were spending on travel, entertainment, food, etc. We were able to generate $4,234 of excess cash flow above the $10,000 a month of monthly requirement, or an extra $51,000 a year in excess cash flow to allow them to do the things they dreamed about in retirement, Dan.
Well, it puts them in a perfect position because imagine you can pay for your budget of $10,000 every single month, no issue, and you still have $4,200 more to spend than you need that you can use for extra spending, for saving, for gifting, anything you want. It just makes you feel more comfortable that you're going to have more money per month than you need to spend, which is what will make you stop worrying about your money so much. And once we do that type of calculation that shows you're going to be fine throughout retirement, almost every single person says, okay, well then how much am I going to be able to leave to my kids and grandkids? What's my legacy? So let's assume your portfolio only earns an average 4% rate of return, your bank earns 1%, and your real estate appreciates by 1.5%. And let's assume in this example, Rob and Terry spend all that income we're giving them. They never save any of it in the future. Well, by age 90, they would have taken out and spent $3.5 million of income. That's just awesome. $3.5 million of income off their assets that they spent on having a great retirement. And if their portfolio only earns 4%, their bank earns 1%, the real estate earns 1.5%, after taking out the $3.5 million of income that they've spent, they're still projected to have $6.7 million left that they can leave to their beneficiaries, which is just an awesome way to then pass on some of that wealth to the future generations. So how about summarizing this up?
Well, you know, putting together a plan is like putting together a puzzle, right? There's all these ingredients of the recipe file that we have to kind of put together so that all this is going to work for it. And the only way we can do that is put together a full written plan for every client. They will feel more organized. They were going to have local representation rather than something outside of the market. They felt more successful and secure. We increased their income substantially with guarantees. We got them an extra $50,000 a year of excess cash flow. We reduced their risk. We reduced their fees. The house was paid off. the remodel was accounted for, and they could leave money to their kids and grandkids. And guess what? They started worrying a lot less, Dan.
Well, and that's because they had a plan that was all based on achieving their goals, and their money was invested in the plan to achieve those goals, so they didn't have to worry about anything any longer. So by creating a plan, just like you can stop worrying about your money so much. Mark, back to you.
Wow, guys, great results from a great plan. Your situation may not be exactly like Rob and Terry's. You may be married or still working, but you could see how planning can help you attain your goals and alleviate some of your worries about money. If this is something you'd like help with, give us a call right now. Pick up the phone 916-452-7325 or visit our website. Now stay tuned for a great complimentary offer.
Hi, I'm Dan Ahmed, President of Peak Financial, your local resource for retirement and investment planning, acting as fiduciaries for advisory clients. If you're a Northern California retiree or pre-retiree and worried about running out of money in retirement and how to create dependable income to replace your paychecks so they last for as long as you live, we have a great free offer for you. Our typical clients have $1 million to $5 million of retirement assets, but we can help you if you saved at least $500,000. We're offering you a free, worry-free retirement roadmap that includes a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all for free. No pressure, no obligation, guaranteed. It's time to stop worrying about your money. Don't wait. Call the phone number on the screen or go to our website to claim your free offer. You have nothing to lose, there's no pressure, there's no risk, and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Welcome back to the program. Now let's listen in on the Peak Financial Freedom Hour with Jim and Dan.
Jim, great to be back for this week's Financial Freedom Radio Show Hour. And we always like to cover questions we've heard in the past from people and look at how we'd answer them, because we think a lot of people right now are probably having these same questions that we've heard before. Let's look at Tim and Elizabeth. Tim says, I have an MBA, understand investments, and handle our portfolio, and I've always done okay. But I'm 70 now and I don't have the same passion and fun managing the money. In fact, I worry about it more and more every day. My wife is actually worried about me worrying, and she also worries about how in the heck she's going to handle the money when I'm gone because she's never done it. In your honest opinion, is there really any reason for me to work with an advisor?
Well, you know, Dan, we have a lot of people coming into our office with those same concerns. The man in this example has been managing money most of their lives. He's worried about maybe longevity. What happens when he passes away? Can his wife take over? She's worried with the fact that she probably knows nothing about the money because she's been left out of it. You can accomplish all these goals by, yes, meeting with an advisor that does do planning. It doesn't mean that you have to relinquish all the money, because he may still want to manage some of the money, but unless you have a plan put together, not just a bunch of brokerage statements or this is what you should do if something happens to me, but have a full written plan there for the spouse, an income plan, a tax plan, a legacy plan, a risk plan, a fee plan. All that in writing, it will make both of them, Dan, feel significantly more comfortable.
Definitely. Well, I think they're actually worried about two things. I think he worries about rates of return and is willing to take high risk. I will almost guarantee she worries about risk and doesn't want to take too much risk.
Probably.
So you have to do exactly what you said and build a plan that now joins them together. Yeah. So now we have something they both can agree to as far as the amount of risk they want to take, how much income they're going to need, and just make them feel comfortable, because if he's gone, and he probably has a higher probability of going first, we got to make sure she's protected.
Exactly.
How about, let's look at this one. Jeffrey and Jan. We've retired and saved $4 million. We worry about our money all the time, but for different reasons. Jan worries about losses, kind of like what we just talked about, running out of money, not knowing what to do, and making a mistake. Jim worries about not making big returns and missing out. Is this normal, and what can we do? Well, it sounds pretty normal, because that's kind of the same thing we just talked about for the first one. And first of all, if they've saved $4 million, they've done an outstanding job of accumulating assets. They probably don't think they have done a great job. They probably think they've just, done an okay job, because we find our clients, especially the more they've saved, the less they feel like they've actually succeeded. They have no idea that they've got to this position. And they're worried about their money right now because they don't have a plan. And the one thing that would help Jeff and Jan stop worrying about the money is if they actually had a plan. And a plan isn't just a portfolio statement. What if in writing you could have all of the income you're going to receive each year and each income source show for the next 30 years. So you know where your income is going to come from. Then that's one less worry you have to have. What if we could show how much risk you're taking? Meaning if the stock market crashes 50% like it did in 08, how much should you be planned to lose as far as a projected potential loss? What if you could finally know how many fees you're paying and you had it in writing? What if you could see this? This is the coolest part. What if they could see their gross income per month, their taxes per month, their net after-tax income, and then showing minus their budget, and then showing what their net excess money is above their budget on a monthly basis? It would help them stop worrying about their money, and it could show them that they really don't have that much risk inside the portfolio if it's designed properly.
You know, Dan, you design a plan because that's what we do every single day with every client. But this is foreign language to people listening right now because their advisors or these brokerage companies, they don't do plans. You know, we do planning. We're architects of building out portfolios that are going to work in retirement so you don't lose too much money. So you understand what you're doing. You have your income plan in place, your tax plan, your legacy plan. And unless you have all that stuff in place, I don't see how you can go through retirement and not worry all the time.
Well, unless you have that plan in place, how in the heck can you ever get someone like Jeffrey and Jan on the same page feeling comfortable? And we can, and we find out it helps marriages, it'll help their relationship, it'll make them enjoy retirement longer, and that's the whole goal. So we know people have these same types of questions out there, and if you do, we'll be glad to give you a free second opinion. You can call us, we'll be able to answer your questions. You also can go to our website, and you can get a lot of data there, but you also can set up a time right there if you want to meet with us to handle some of these types of issues so you can feel more financially secure.
Thanks, guys. That was some great information. Don't go anywhere. We'll be right back.
Hi, I'm Jim Files, CEO of Peak Financial, your local resource for retirement and investment planning, acting as fiduciaries for advisory clients. We're offering you a free, worry-free retirement roadmap, including a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all free, no pressure, no obligation, guaranteed. There's no risk and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
There seems to be a lot of misinformation or fake news out there about investing and planning for retirement. Much of that information is provided by people and sources that have a conviction in what they're saying, even though a lot of it may not be correct. Today on Peak University, Dan and Jim are going to be discussing how they help retirees avoid falling victim to fake news.
Thanks, Mark. And you know what? We think there's so much fake news out there, and it's not necessarily done on purpose. It's just that a lot of advice given out there is not necessarily proper for people that are in retirement or getting ready to retire because they're in a whole different part of their life at this point. So we always like to ask people, how are you told? And it's a nice graphic, this person with an umbrella in almost a tornado being blown sideways. How do you feel when you're told, hang in there, ride it out, and stay the course? Meaning no matter what, suffer that loss and hopefully you'll recover. Well, you probably feel like that person that's hanging in the air sideways being blown by a tornado. So Jim, one of the things we talk about and we try to teach people is what we call our two myths in the financial world. You're always told to ride out the market, hang in there, and everything will be fine, and you'll get a 12% or better rate of return each year in the stock market. That's what people are told all the time, and we know these are myths. Let's just cover the S&P 500 and a graphic format from the year 2000 through December 31st, 2022. That's 23 years. And if you look at it, it's a lot of volatility, but a lot of growth as well. So it looks pretty cool. Let's say the S&P 500 started at 1,469 points in year 2000. In the end of 2022, after a drop in the market, it still ended at 3,853 points. So you still got this huge gain if you hung in there and rode it out, which makes a lot of sense to people. Because look at that huge gain over that time period. You made a lot of money. Well, no one goes to the further extent to tell you the average annual increase of the S&P 500 index during that 23 years was just 4.28% per year before you took out income distributions, before you paid taxes, and before you paid fees. So is a 4.28% gross annual increase worth all the risk we took? We don't think it is. Well, how did it happen? In 2001 and 2, the market dropped 50%. And it didn't drop 50% all at once. It went down 10%. They told you, hang in there, ride it out, stay the course. You did. You lost some money. And then it went down another 10%. They said, don't worry, it's not going to go down any further. Hang in there, stay the course, ride it out. You did. And at the end of 3 years, you're down 50%, and you have no choice other than staying in there at this point. Then you needed a 100% gain for the next 4 years just to break even, which means you were happy that you made 0% for 7 years. And they said, don't worry, we'll never have those types of losses again. Then 08 financial crisis hit, which you'll remember, same thing. Stay the course, hang in there, ride it out, you lose 50%. You needed another 100% gain just to recover. And the stock market, the S&P 500, was finally back to 1,469 points 13 years later in January 2013, which means for 13 years, Jim, the S&P 500 went up by 0. So our clients are really good savers. So their accounts went up, but not because they had growth in the market, because they're really good savers, and it went up because of their additional contributions.
That's exactly right, Dan. But you know, Dan, we look at money differently. We actually manage assets differently, and we'll give you an example. So I want you to imagine, rather than somebody put you into a portfolio and you call them once a quarter, and when the market goes down, they tell you to stay the course. We're not going to tell you that. We are mechanically managing money with algorithms. It's all done with math and science with no emotional decision making. So for example, let's say we have 44 different positions we're analyzing every day through the course of every month. We have 20 individual stocks. These are the top stocks on the NASDAQ and the S&P 500 that the algorithms determine. We have 8 inflation-focused ETFs. These are commodities. These are like lithium and gold. These are big funds. We have 8 equity-focused ETFs. This is the Dow, the S&P, the Russell, emerging markets, et cetera. And then we have 8 fixed income focused ETFs. And again, these are like treasury bonds, high dividend paying bonds, et cetera. So the algorithms are tracking this individual data all month long. On the first day of every month, it determines, do we have any momentum any place? And it picks 8 of those and gets rid of the other 36. And then it runs a risk mitigation software application over those 8 to determine how you're going to allocate the fund to each one to make sure we can mitigate as much risk as possible. And then every day it runs what is called stop loss technology, so that if the market momentum changes negatively too much in the month, we stop out and go to cash. So imagine your money being managed that way versus someone telling you to stay in it no matter what happens, Dan.
Well, if you think about it, if you're tired, sick and tired of hearing, hang in there, ride it out, stay the course, this is the only way you'll be able to avoid those phrases and avoid having to hear those things, because we're never going to say that. We're going to readjust the portfolio every month, just like most clients want their portfolios to be adjusted. We're going to use stop losses. If the market gets too crazy, we get out of the stock market, just like what most clients want, but their current advisor or their 401k companies won't do it. So this is the one way we'll manage money in the stock market, in the bond market. And then we also are going to have a guaranteed component. We're going to use a fixed index annuity for those people that need lifetime income and that want 100% protection against stock market losses on that portion of their assets. Let's assume we use a single male, female, age 65. Income is being guaranteed to be paid to them for as long as they live. Doesn't matter how long they live. Doesn't matter if the stock market crashes. Doesn't matter how much their account earns. They're contractually guaranteed. And it works pretty cool, because let's say they have $1 million being funded into an account. Most people, if they're 65, they're told, oh, you can't use an annuity because you're too old and you got to wait 10 years to touch it. That's not true with a lot of annuities. We'll use plans where someone comes in, they're 65, and they say, I need income immediately. We literally will fund the plan and start their income within 30 days. That's immediate income. So if we have $1 million go in for a single person age 65, how would you like to get $68,000 of guaranteed income coming out every single year, which is a 6.8% starting number, and it never can go down below 6.8. It actually might go up, but it never can go down less than 6.8% of your $1 million. What if now you deferred it for 5 years, and now instead of getting $68,000, you deferred it, you didn't take income payments, and after 5 years, you're getting $105,125 per year guaranteed for as long as you live. Jim, that's a 10.51% payout. And of course, if you defer it, you get more, but what if you can get that 10.51% payout on $1 million just guaranteed for as long as you live? What does that do to someone's financial security and their mental well-being?
Well, it's awesome. But the key to all this is making sure that you understand there are other strategies, there's other financial instruments. You devote enough money in each one of these buckets that we talk about to accomplish your goals, your specific goals in retirement.
That's exactly right. And that's the only way you'll stop worrying about your money so much. Mark, back to you.
Thanks, guys. I had no idea that over the last 23 years, the stock market only increased by an average of 4.28% per year. Before fees, income distributions, and taxes. That's brutal. The good news is there are potential solutions. If this is something you'd like to learn more about, hey, give us a call in the office at 916-452-7325 or go to our website.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Thank you for watching this week's show.
And if you want more information about anything we talked about here today, give us a call in the office or go to our website.
And remember, at Peak Financial Freedom Group, we fix your money.
The preceding program is sponsored by Peak Financial Freedom Group.